Hey friends, dividend stocks that are really popular like Johnson & Johnson and PepsiCo, I own both of these stocks. They are trending down in share price. And by traditional valuation metrics, they appear to be on sale right now. The starting yields are high, the PE ratios have gone down, and a lot of dividend investors, myself included, are looking at these stocks and even averaging into these stocks right now. It's exciting in 2025 to have some of these value opportunities. Now, this sale right now is not exclusive to J&J and Pepsi. There's also a lot of other dividend stocks that are kind of out of favor right now, if you will. They're trading at value levels. But I want to share with all of you as an investor, a longtime investor in these stocks. In fact, I've been in PepsiCo since 2011. When I look at the stocks right now, I am excited. I see high starting dividend yields, but also I believe there's been a fundamental shift in the marketplace. I also believe that many people out there right now are completely ignoring the shift that is happening in front of us. I am trying to recognize what is happening right now because it affects my strategy in how I move forward from here. And so I want to just start out today with a slide. As you can see on the screen in front of you right now, this is what's happening. What's happening right now in 2025 is traditionally favored dividend stocks are now out of favor, even high quality names. Why is this happening? I believe it's due to the high Treasury rates because income investors have options now. The only option in town is not dividend stocks. Income investors can move their money into treasuries and get really high yields right now. I think there's slower anticipated growth. Certainly my anticipated growth for my investment in Pepsi looking forward from here is not as high as it had been when I started buying back in 2011. Can PepsiCo really increase prices on consumers anymore here? Where will the growth come from, for example? Also, I see these stocks on sale just due to increased risk factors. Of course, the new administration with changes in the FDA, this could really change how stocks like Pepsi operate. Could the FDA put new rules in place that make it more difficult for Pepsi to use certain ingredients or even ban certain ingredients in the snack foods and beverages that they produce? On top of that, there is really a strong amount of growth in the weight loss drugs these days. And could those also have an effect on stocks like Pepsi? And so there's these risk factors, there's these contributing factors right now that is putting pressure on a whole class of quality dividend stocks. But as you can see on the screen in front of you right now, the investor who needs yield right now doesn't care too much about future company growth, nor dividend growth really. And I'm sometimes of this mindset because that's where I'm at in my investing career. I'm increasingly utilizing dividends right now. I like current yield, even more so oftentimes than dividend growth. This may be a good opportunity. It may be a truly great opportunity. And so let me look at this. Basically, I'm getting a starting yield on PepsiCo shares if I buy them now at about 3.74%. That's really high for a high quality stock like PepsiCo. And even if the dividend growth is lower than the 7.2% CAGR that I've experienced on average over the last 5 years, maybe that's okay. Put another way, over the last 5 years, the starting yield has never been this high, but the dividend growth, it's been really high. And so investors have bought this stock at lower starting yields because it has had dividend growth ahead of it. And that dividend growth creates yield on cost. But looking at it right now in 2025, even if we assume lower growth on PepsiCo going forward, well, the starting yield right now, it's adjusted up. It's a higher starting yield. And so many investors probably still feel comfortable buying Pepsi, even if they believe growth is slower in the future with the dividend, because the starting yield is high. And of course, this is so personal. All investors have different goals. When I was younger, when I started buying Pepsi and J&J, but Pepsi was the one I started buying in 2011. I'll have to look when I started buying J&J, probably around the same time. My goals were more towards dividend growth when I was buying these stocks. But right now, because I've gotten older, I'm fine not only holding what I have, but adding to it. But the goals have changed. And I think it's really important to recognize that buying PepsiCo now is very different than buying PepsiCo in 2011. It's not really, in my opinion at least, as high of a dividend growth rate or earnings growth rate or revenue growth rate going forward. And so that's slide one. That's kind of takeaway one. But this builds. I want to share a story with all of you. So as you can see on the screen in front of you right now, slide two. And so what I want to share on slide two, let's not lose sight of a major shift that has happened in our market. And it's continuing to happen. And so again, I started buying PepsiCo at $63 in 2011. PepsiCo of 2025, it is not the same as PepsiCo of 2011. It's a much bigger company now. A lot of the growth has been realized, and that's wonderful. But I do not have the same growth expectations going forward. I'm still buying stocks like PepsiCo. I'm fine with the higher starting yields because that compensates me for a lack of perceived lower dividend growth going forward. Hey, maybe they're going to surprise me. Maybe the dividend growth the next 5 years, it's going to be just as strong as the last 5. But right now, from where I sit, from where I look as an analyst, I'm not expecting that. I just can't expect dividend growth 7+% per year going forward for the next 5 years. That would only happen if earnings were growing that fast. And I just don't see that materializing over the next 5 years. But hey, maybe they will surprise me. But as you can see on the screen in front of you right now, I want to share some more stuff. So all of this said, a fundamental shift is happening. About 5 or 6 years ago, I published a video. Actually, I published 2 videos. In fact, I want to do this. I'm going to share some screenshots on the screen while I'm speaking right now. When I published these videos 5, 6 years ago, I spent a lot of time on analysis. And so check out the screenshots in front of you right now. I analyzed my performance versus the S&P 500. And hey, my analyses may not be perfect, but I spent a lot of time on them, and I think they are mostly accurate, at least close to being accurate. And what I found at the time is my performance of my portfolio overall, counting capital appreciation and dividends, was roughly comparable to the S&P 500. And on good years, I was even beating the S&P 500. That was 5 or 6 years ago. That was kind of my experience back then. Fast forward to today, to 2025, things have evolved quite a bit. And over the last few years, the tech stocks, the growth stocks, the Magnificent Seven have truly flourished. And they have really bolstered the returns of the S&P 500. And no longer is my portfolio keeping up with the S&P 500. And so as you can see on the screen in front of you right now, I have it there on the slide. No longer am I beating the S&P 500. For now, at least. Now, last few years have been really strong for the growth stocks, for the Magnificent Seven, but maybe value will come back and do a lot better than the Magnificent Seven going forward. I don't think so. I actually don't think that will happen. But taking all of this into account, that is okay. I love having maximum total returns, but I love more having cash flow that pays my bills. And honestly, my risk tolerance level, it has gone down. Over time, it's gone down. As I've gotten older, I have had less of a tolerance for risk in general. And so I've come to terms with what's happened, but I want to keep building. As you can see on the screen in front of you, this is slide 3 now. So what I want to share in this particular slide is I need to question everything. I think one of the greatest powers of any great investor is to take a step back and be self-critical of one's portfolio. 2025, I think it's a great time to question everything. Is my strategy of 2011, which worked for me for the last 14 years very well, is it still valid now? I think it is, to be honest. I think it is, and I'm assuming it is. But I must adjust expectations. As I've already mentioned, are my expectations of PepsiCo's performance going forward for the next say 14 years the same as the last 14 years? No. But is my starting yield higher for any shares that I buy today? Or if I reinvest and buy shares that way, it's higher. And that kind of compensates me for it. And I'm happy with it. But that's point one. Point two are the risks in 2025 different than 2011. You better believe it. I see a lot more risk now. Are the very value stocks that I consider safer and lower risk, are they actually higher risk than the Magnificent Seven stocks? This is a really, really key question. This is why I highlight all of this. I highlight this one. I highlight the key points on the screen. I don't want to generalize too much, but in general, I've been thinking about this a lot. And this is where I'm starting to see a fundamental shift. I would say on a go-forward basis, when I look at a stock like Altria, it's in the news now too. The FDA is actually thinking of banning a key ingredient that goes into their products. This could fundamentally alter a company like Altria quite a bit. But putting that aside, let's just look even higher level. Do I see more risk with something like Alphabet or Google, ticker GOOGL, or with Altria? I actually see more risk these days with Altria, even though it's trading at a PE that's much lower than Google's. Let's, though, take Altria. Of course, we always knew there's risk there. Let's look even at something like PepsiCo. Going forward right now, do I see more risk with PepsiCo or with Alphabet, Google? I would venture to say I actually see a little more risk with PepsiCo even than Google. And this is a new way of looking at things. Maybe you all at home have already been thinking about this way, but this has taken me a while to kind of arrive at this conclusion. And just in my mind right now, that's how I'm starting to look at things. Am I going to make wild changes in my portfolio? No, but I need to be honest. I need to question things because our world is evolving. But as you can see on the screen in front of you right now, I want to share more. So do I need to adjust? Perhaps. I have a huge focus right now on CPG Food, sin stocks, restaurants. Not only can I probably expect slower growth, and that's fine, but I need to really be honest with myself that I see external risk forces against these companies. Some of these companies may have higher risk than I actually kind of think. And so you've already seen my 2025 strategic goals. And if you haven't, I'll link to them in the pinned comment below. I have a bunch of videos on it. I'm moving towards added diversification. I'm diversifying with stocks like SCHD, which is an ETF, Chevron, Realty Income, Alphabet, etc. Will I be able to move fast enough? And so you can quickly see I already put into motion my goals for this year. And if you take a step back from why my goals are the way they are, I'm trying to diversify. And I'm trying to diversify very, very quickly here because in 2025, I believe it's more complex to be an investor, certainly than back in 2011 when I was buying PepsiCo. It was different days back then. It was really different days. And when I look here in 2025 forward, it is much more difficult to pick individual stocks. There are much more risk factors than before. And I just see more external factors coming to play that just didn't exist before back in those days, or at least I was naive back then and I didn't see them. I don't think that was the case. I'm a really good stock analyst, in my humble opinion. And when I was looking at things back then, I did not see the kind of risk that I see these days. And so you already know my goals for the year. I've shared them in the pinned comment below in other videos, but it's really around diversification, and there's no quicker way for me to diversify than to buy something like SCHD. It's really easy for me to diversify with something like Chevron because I lack too much energy exposure in my portfolio. It's easy to diversify with Realty Income because not only is Realty Income a diversified REIT, but also just their business model, I don't see coming under a lot of pressure with the risk factors that exist today. And last, Alphabet, Google, that's instant diversification because I'm pretty low on tech exposure. But I want to keep going. I have some more things to share. So as you can see on the screen in front of you right now, this is the kind of last slide, slide 4. I'm going to continue to buy my core stocks like PepsiCo and J&J. I've already mentioned this, not quite as aggressively as in the past, but I'm reinvesting dividends still back into them. I see value, and I'm picking up shares. I see value. But I'm at a point where I really need to go all in on my theme of diversification. This time, in my opinion, is different. This is kind of one of the key points that I wanted to share with all of you. I view myself as CEO of my stock portfolio. I believe managing a world-class dividend portfolio, I know a lot of you watching, you're doing this at home just like I am. It's a job. It's a CEO-like job, and management decisions are necessary. It's strategic. There's a lot of thought that goes into it, and I have to look at things critically. I believe this time is different. This time, as the value stocks correct, I don't think it's just like, oh, they're on sale, it's a buying opportunity, kind of like, hey, everyone, buy the dip. Maybe I'm wrong. Maybe it is just that, but I don't think it's like the last, say, dips of, say, the last 14, 15 years where the stocks are down and, hey, just buy the dip. I think this time they're down for a reason. And I explained the 3 reasons in slide 1. And that's okay. It's okay because these are still, in my opinion, stocks that I own that I've mentioned, many of them today. These are world-class companies that I stand behind, that I feel comfortable owning for my personal situation, of course. I'm not offering any kind of investment advice. I just share my personal journey here on YouTube for fun and entertainment. I feel very comfortable in these stocks, but I have to be real with myself as CEO of my portfolio. Hey, Ian, be critical of it because this time it's probably is different. But as you can see on the screen in front of you right now, I want to keep going. So to that end, I have some exciting news. It's very small. My patrons already know this. I'll link to it in the pinned comment below. But I initiated I'm going to link to Patreon in the pinned comment below. I initiated a position in Alphabet recently, ticker GOOGL. What I rationalized is I de-risk my portfolio by adding this much-needed Magnificent 7 exposure. And I was able to add it because, yes, it now pays a dividend. And I hope that dividend will grow over time, maybe even quickly. The reason I chose Alphabet is out of all the Magnificent 7 stocks, I see the most value there. I'm still a value investor overall, and as I look forward, on a forward 2024 basis, they're at like a PE of 24 range, and forward 2025 basis, PE ratio in the 21 range. And so after all, I still am a value investor, and I'd love to add Apple to the portfolio as well, but with the PE as high as it is right now, I'm not going to be adding Apple. I would have to see that stock retrace a bit or earnings catch up with valuation. But on Alphabet right now, Google, I anticipate this being a stock that I add to through the course of the year, and I build it in size. And I rationalize that, Ian, you are taking on a lot of risk in your portfolio by not owning this. And yes, it does not add a lot of cash flow right now. And that's kind of at odds of where I am in my journey as an investor because I need cash flow now. But the added diversification of bringing something to that portfolio vastly outweighed, to me, my needs for cash flow, and I'm making up for those needs elsewhere with the other stocks. As you can see on the screen in front of you right now, I also additionally need to remind myself it's of great importance to build my positions in SCHD. I actually bought some recently. I'll share again, on Patreon, I shared it, so I'll share in the pinned comment below, link to my Patreon. Chevron, Realty Income as well. So those are all positions I need to remind myself of to build because whereas Alphabet's not bringing a lot of cash flow right away, these other ones are. Now, all along, I must remain hopeful that the other positions in the portfolio like Pepsi, J&J, and Altria do not face any kind of major challenges or issues in 2025. I'm hesitant. I think they might, but I remain strong. I have a long-term focus. And like I said, I'm buying PepsiCo and J&J. I've bought some shares recently. I'll continue to buy more, probably not as aggressively, though, as probably the Ian of the past would have, just because I see a greater emphasis for my personal situation right now on the other strategic priorities mentioned today. Now, here's a quote that Sir John Templeton shared that I was reminded of by my friend Brandon Beavis. Brandon Beavis, by the way, he co-founded in a social media platform called Blossom Social, as you can see on the screen. Blossom Social is such a great place to engage with other investors. I will link in the pinned comment below. I'll share my affiliate link. In terms of full disclosure, I am an affiliate of Blossom. I get compensated when people sign up, but the platform, it's free. And there's a paid version as well, but it's free to sign up. And it's amazing. It's a very great community. It's quickly becoming, other than YouTube, my other favorite social media platform of choice for investing, because it's just really good conversation. There's none of the mindless or bad or kind of detracting content there. It's just good stuff. It's a great community over on Blossom. But Brandon Beavis shared this quote on Blossom a while ago. And so I'm kind of borrowing it from you, Brandon, but I'm also borrowing it from John Templeton. But as you can see on the screen in front of you right now, the quote goes like this. It says, "Hey, stocks climb a wall of worry." So, hey, I'm sharing a lot of worries with all of you today, but maybe this worry is a good thing. Maybe all of this kind of hypothesis and all of this kind of critical thinking that I'm sharing with everyone today, it is kind of more on the worry side as it pertains to my legacy portfolio. It's on the optimism side as it pertains to where the portfolio is going, but I have to get from point A to point B. I rarely sell stocks, and stocks like PepsiCo, J&J, of course, for me are hold forever. And so as I have some anxiety, I have some worry about the legacy portfolio. How do I get from point A to point B? I just got to move fast. I got to move fast and deploy net new capital or selectively reinvested dividends into the new positions like Alphabet and SCHD, which is SCHD. It's already become quite meaningful in the portfolio. Alphabet's real small. But that's where I got to go. And again, I'm worrying, but stocks climb that wall of worry. And so it'll be so interesting to check in 5 years. How does PepsiCo do? How does Johnson & Johnson do? Do they perform as well as they have historically, or does growth slow down? And like I said in slide 1, even if growth slows down, the starting yield is pretty sweet right now. And I think that may hold some investors over at least, and kind of convince them at least to enjoy the slower growth because of the higher starting yield. But let me know what you think in the comments section below. Do you agree with any of the things I'm thinking these days? These are all the thoughts I've been trying to articulate to the community this year, but it's taken me a while to really condense all of these thoughts into this format. And it helped a lot. Today, actually, I talked to two friends. My friend Joe, shout out, and I talked to my friend Chris as well, shout out. And talking with my friends kind of about these particular topics as well, it helped me better articulate my thoughts. But I'd be curious in the comments below what you think about all this. And if you enjoyed the video, please don't forget to click the like button. And of course, please remember to subscribe. It means the world to me. I'm so thankful for all of you. Before I go today, in terms of a full disclosure, I am long the stocks and ETF mentioned today. In terms of full disclosure, I'm long PepsiCo, ticker PEP, Johnson & Johnson, ticker J&J. I'm long Altria, ticker MO. I am long Alphabet, ticker GOOGL. I am long Realty Income, ticker O. I am long Chevron, CVX, and SCHD. I own those positions in my personal dividend stock portfolio. Before I go, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. Thank you for watching, everyone. I'll see you in the next video. I'll see you in the comments below. Have a wonderful day.